Welcome, everyone. I'm Amanda Packel, here to welcome you on behalf of the Stanford Rock Center for Corporate Governance. We're extremely grateful to the SEC's San Francisco Regional Office, especially Gina Choi, Rebecca Lubens, and Carlos Vasquez for partnering with us for the second year as part of its Silicon Valley initiative, and also for securing the participation of SEC Chair Mary Jo White and Director of Enforcement Andrew Seresny. I also want to thank our program group, Trish Gertridge, Jackie Del Barrio, Jody Carrion, and Casey Limjenko for working tirelessly behind the scenes to make everything run smoothly tonight. And now I'll turn it over to the director of the San Francisco Regional Office, Gina Choi, who has the honor of introducing Chair White. Thank you.
Oh, good evening. Thank you, Amanda. Thank you so much for joining us for our second Silicon Valley initiative. We are thrilled and delighted that you're here tonight. And before I introduce our keynote speaker, Chair Mary Jo White, on behalf of the San Francisco office of the SEC, I want to thank Stanford, the Rock Center, Joe Grunfest, Amanda Packel, and the Stanford Law School program group for working with us on this great event. The Silicon Valley Initiative was originally an idea conceived of by our staff who wanted to reach out to the issuer, registrant, and capital raising community here in Silicon Valley. After attending the Rock Center's annual Directors College, several members of our office were inspired by Arthur and Tony Rock's work sponsoring conferences and seminars and raising awareness of issues surrounding trust in the investment community and at our public companies. We believe tonight's program, which considers protecting investments in pre-IPO issuers, a topic we settled on several months ago, is particularly timely and relevant. It is also somewhat fitting considering Arthur Rock's role as a trailblazer and as one of the original venture capitalists who built Silicon Valley. Ordinarily, when you hear from our office, it's because we may be starting an investigation or an examination. Not always the best circumstances to exchange ideas and engage in fruitful dialogue about industry trends with your regulator. So through this event, staff in our office wanted to create a means by which leaders at the SEC and stakeholders could discuss key regulatory issues, particular to the dynamic and innovative VC, startup, and entrepreneur community in Silicon Valley. We believe that events like this one furthers our mission of protecting investors and facilitating capital formation. So thank you for coming and taking time out of your busy schedules to join us as we discuss these important regulatory issues. I wanted to recognize our Silicon Valley Initiative team, Rebecca Lubens, Carlos Vasquez, Bill Saltzman, Joe Seglio, Aaron Schneider, Kristen Snyder, and Judy Anderson, who put so much thought and effort into organizing this event. And we wanted to thank Andrew Seresny, the Director of the Division of Enforcement, as well as the Chair's Deputy Chief of Staff, Michael Liftick, who have been incredibly supportive of our efforts. So now on to our keynote. Please join me in welcoming Chair Mary Jo White, who I believe last spoke at Stanford and the Rock Center at Directors College not quite 2 years ago. Chair White was appointed to serve as the 31st chair of the SEC by President Obama in 2013. She came to the SEC with decades of experience as a federal prosecutor and securities lawyer. As the U.S. Attorney for the Southern District of New York from 1993 until 2002, she specialized in prosecuting complex securities and financial institution frauds, as well as international terrorism cases. Under her leadership, the office earned convictions against the terrorists responsible for the 1993 bombing of the World Trade Center and the bombings of the American embassies in Africa. She is the only woman to hold the top position in the 200-year-plus history of that office. After leaving her U.S. Attorney post, Chair White became chair of the litigation department at Debevoise & Plimpton, where she led a team of over 200 lawyers. For those of us who have worked with Chair White, we know she is laser-focused on doing the right thing, and her leadership, support, and commitment to protecting investors is palpable. With that, it is my distinct pleasure and honor to welcome Chair Mary Jo White.
Thank you very much, Gina, and thank you for your leadership of the San Francisco Regional Office, as well as this initiative. You just do a tremendous job. It's always just terrific to be back here at Stanford. Joe Grunfest did apologize to me for the weather, but I'm trying to bear up, but seriously, it's great to be here. It's also a real honor to speak at the SEC's and Rock Center's Silicon Valley Initiative. This is really a very important event that brings together regulators, academics, lawyers, entrepreneurs to discuss the issues impacting the startup, venture capital, and private equity worlds rooted here, and obviously what is a cutting-edge center of technological innovation. It really is essential that the Commission fully engage with Silicon Valley and participants in this important market really across the country so that we can better understand the unique features of that market and of the investors and financings in it. This Valley SEC dialogue, which I do hope becomes a permanent fixture, and it should, can only make the Commission a more effective regulator and help us to better protect all investors. We all know, you especially, the significant impact that technology innovation coming from Silicon Valley continues to have on all of our lives. We see the effect absolutely everywhere. Companies that trace their start to basements, shared office spaces, and classrooms are changing how we get around our cities, how we analyze big data, how we find places to stay when we travel, how we communicate with each other, and even how we put satellites in space. As technology has evolved, so too have the financial markets that support it. New models for how these companies are funded and how investors unlock their value are changing the landscape for private startup financing and the IPO market. SEC rulemakings have also opened new ways to raise startup capital with general solicitation allowed in private offerings, securities-based crowdfunding campaigns coming soon, and an updated and expanded Regulation A, known fondly, at least at the SEC, as Regulation A+. New approaches to secondary market liquidity have sprouted. New types of investors have entered the mix, including mutual funds. And all of these factors are contributing to the decision made by more and more companies to stay private longer. I thought I would spend my time with you tonight really discussing some of the opportunities, challenges, and risks in these rapidly changing markets. A very important part of the SEC's mission is to facilitate capital formation. So it is important, very important, that our rules and regulatory actions create an environment that fosters innovation and growth. But entrepreneurs and issuers in these new markets should also recognize that protecting investors is at the core of the SEC's mission, and it should be something that they, too, hold at the core of what they do. Being a private company obviously does not mean that you can disregard the interests of investors. Indeed, being a private company comes with serious obligations to investors and the markets. Whether the source of the obligation is the federal securities laws or the fiduciary duty that is owed to shareholders, the resulting candor and fair dealing should be fundamentally the same. And beyond, any specific regulatory requirements, some of the principles that characterize public companies, transparency with investors, controls in financial reporting, strong corporate governance, have applicability and relevance to private companies, especially those pre-IPO companies that aspire to go public, and should not be overlooked or avoided, whether or not mandated by federal law or an SEC regulation. For the new and evolving markets to be successful, all investors need confidence that they're being treated fairly and that the full range of risks are transparently disclosed. We must work together, and I really mean we must work together, to ensure that this confidence is well placed so that investors feel comfortable providing the capital essential for business development and growth. Only then can we fully reap the full rewards of the creativity, genius, and innovation for which this valley is so famous. Let me first focus on the accuracy of disclosures made by pre-IPO companies. It's undisputed that venture investing is not for the faint of heart. There is certainly nothing novel in this valley about pre-revenue startups attracting millions of dollars, also often much less, from angels, traditional VC firms, and more recently, private equity firms, all looking to add to their portfolio that moonshot, once-in-a-fund investment opportunity. The investors are sophisticated and generally understand well the parameters of the private securities markets. They are aware that most of their investments will fail. Now, while the common refrain is that 9 out of 10 startups fail, an equally interesting statistic that one postmortem analysis that I've seen is that 70% of failed startups actually die within 20 months after their last financing, having raised an average of $11 million. In other words, not only are these investments highly risky, they fail quickly too. From a securities law perspective, the theory behind the private markets is that sophisticated investors do not need the protections offered by the robust mandatory disclosure provisions of the 1933 Securities Act. So if those participants choose, with eyes wide open, to invest in private companies at valuations that may be ethereal or overinflated, who loses when the truth behind inflated valuations is revealed? I think we all do. Not just the VC and private equity funds, but also smaller retail investors and the next Stanford student whose great idea needs funding, but investors are unwilling to take a bet on her because they were burned last time. Now, to better understand what I mean and I'm talking about, we need to look more closely at how these deals are done and structured, as well as the downstream effects on other market participants. A current feature of the pre-IPO financing market that actually puts these questions, I think, in sharp and I would say local relief is one that has gathered considerable attention recently, unicorns. Of course, this audience knows, they might not on the East Coast, but I think they do, that I'm not talking of the creatures of fantasy, obviously, but of private startup firms with valuations that exceed $1 billion. By one count, there are nearly 150 unicorns worldwide, many based right here in Silicon Valley. And they do not appear to be an endangered species. One survey shows that there were 52 unicorn financings in the last 3 quarters of 2015, compared to 37 such financings over the 12 months that ended in March 2015. Now, beyond the hype and the headlines, our collective challenge is to look past the eye-popping valuations and carefully examine the implications of this trend for investors, including employees of these companies who are typically paid in part in stock and options. There are some areas of concern, I think, for the SEC clearly, and I hope an important focus for entrepreneurs and their advisors as well as investors. At the SEC, the questions we're asking are not fundamentally different from the questions we ask about all transactions. They include whether the information supplied to investors is accurate and complete. That is, whether it accurately reflects the performance and proposals and prospects of the company. Making sure that this is so becomes more compelling when the transactions are smaller and the investors are more retail. And for those involved in advising these investors, they have very heightened responsibilities. And I think for those advising unicorns in particular, there's a sort of a related question. How do $1 billion valuations affect all relevant investors, both those investing in the unicorn round and those that came before and after, whether in public or private transactions? It's axiomatic that public and private securities transactions, no matter the sophistication of the parties, must be free from fraud. So Exchange Act section, I should say, 10B and Rule 10b-5 apply to all companies. And we must be vigorous in ferreting out and punishing wrongdoers wherever they operate. In the unicorn context, there is a worry that the tail may wag the horn, so to speak, on valuation disclosures. I would like to hasten to add I did not write that line. Someone else wrote it. I may or may not give him up, but Michael. The concern is whether, but I did agree to read it at least. That's his only line, actually. But, the concern is whether the prestige associated with reaching a sky-high valuation fast drives companies to try to appear more valuable than they actually are. Nearly all venture valuations, of course, are highly subjective, but one must wonder whether the publicity and pressure to achieve the unicorn benchmark is analogous, at least, to that felt by public companies to meet projections they make to the market and the attendant risk of financial reporting problems. And yes, that remains a problem. We continue to see instances of public companies and their senior executives manipulating their accounting to meet various expectations and projections. As I will discuss, the risk of distortion and inaccuracy is amplified because startup companies, even quite mature ones, often have far less robust internal controls and governance procedures than most public companies. Vigilance by private companies about the accuracy of their financial results and other disclosures is thus especially critical. We have our eye on unicorns because of their outsized impact on our markets and investors. However, our primary focus is obviously much broader. One key and current area of focus for us at the SEC is on the 3 new methods that have recently been created by our rules for capital raising under the Jobs Act. Rule 506C of Regulation D, permitting general solicitation, Regulation A+, and Regulation crowdfunding. In one way or another, all 3 of these are designed to foster new ways for smaller companies to access the capital markets, and we must ensure that the investor protections included as part of these new structures work as intended to foster capital formation in a transparent, safe, and efficient way. Now, in contrast to the institutional investors that have typically been involved in the capital raising that has created unicorns, these capital formation tools can be used to, and in certain cases are expected to raise money from retail investors. So it should come as no surprise that we are closely looking at not only how well these tools are working for companies seeking to raise capital, but also how well they are protecting investors. As an integral part of the implementation of each one of these new tools, I've drawn on the expertise of the staff across the agency, engaged them in a program that actively monitors the volume of such transactions, developing industry practices, how the implementing rules are working, and any instances of fraud or other rule violations. I've actually discussed before publicly what these staff initiatives have found for general solicitation and Regulation A+. Tonight, I'll just touch briefly on some of our thinking on the 3rd offering tool of the Jobs Act, crowdfunding, which we adopted actually last fall and becomes effective in May. Now, crowdfunding is an evolving method of raising capital that has been used to raise funds through the internet for almost any project that can garner sufficient interest. But before our regulation, individuals who contributed money to such ventures were essentially just contributing to the project. They were rewarded sometimes with a first-of-its-kind product, a memento, or in some cases, just the satisfaction that comes from being part of a worthy venture. But they were not investors. They could not share in the financial returns of the enterprise. Regulation crowdfunding will allow retail investors to acquire small equity stakes in new companies. Significant excitement surrounds the use of securities-based crowdfunding, which we hope will fuel the development of a vibrant market. It is important, however, for this excitement not to be short-sighted by failing to keep the interests of investors paramount, which could quickly deliver a very damaging blow to the success of crowdfunding. Our regulatory regime is designed to streamline capital formation while still providing robust investor protection. Importantly, the rules require crowdfunding to be conducted by a registered broker or a funding portal, a new type of SEC registrant with an important role as an intermediary between those seeking capital and investors. Entrepreneurs here in Silicon Valley have developed many of these funding portals. The funding portals were established with the primary purpose to serve as a classic gatekeeper. and it is vital that they strongly function as such. As with general solicitation and Regulation A+, in addition to the strong regulatory protections built into the rule, we will closely monitor the funding portals through rigorous inspections and examinations, as well as close coordination with FINRA. And to repeat, we are counting on brokers and funding portals to be bulwarks of investor protection in this space, and we will hold them to that responsibility. Another set of issues that we are focused on in the private markets is the effect of valuations on secondary market participants. In the last wave of technology-focused IPOs, a secondary market was created before the IPOs by early-stage employees that enabled them to sell their stock to outside investors. That market, unfortunately, had some problems. From unregistered broker-dealer activity to conflicts of interest and undisclosed compensation to fraudulent offers of pooled investment vehicles that purported to hold pre-IPO stock. These issues stemmed in part from the fact that secondary market investors did not have access to accurate information concerning the value of the companies in which they were investing, either directly or indirectly. And care should be taken to avoid these issues in the new secondary market that is emerging, structured largely around derivative contracts and other novel ways to capture the economic interest in a pre-IPO company without actually transacting in its stock. And depending on the structure of these derivative deals, errors or misconceptions in valuation could be amplified, whether through leverage or simply contracts built on faulty valuations. These secondary markets also raise other issues. A primary concern is whether they have or will have sufficient liquidity to allow investors to trade out of their positions, and that they are transparent as to what that liquidity actually is. Recognizing that many participants in the secondary market may be buy and hold investors seeking exposure to late round pre-IPOs so they can profit from an eventual IPO or acquisition, we still must scrutinize these emerging platforms to ensure that they provide a functioning market that operates within the parameters disclosed to investors. We must also look carefully at the role of gatekeepers, such as the financial advisors who recommend these investments to their clients, and the potential registration regimes that might apply to the operators of these marketplaces. Again, we are counting on the advisors to make those markets work fairly for investors, ensuring that they are well informed of the significant risks they are taking. Another area in which pre-IPO companies, including unicorns, present risks for investors centers on financial controls and corporate governance. As many companies are choosing to stay private longer, Silicon Valley has become home to many private companies with valuations that exceed many listed ones that in another time would be publicly traded. So this is very much an issue for you. The theories about the current slowdown in IPOs and why unicorns are staying private longer, while a very important topic, are really beyond the scope of my remarks tonight. Whatever the cause, there are several governance implications for the longer pre-IPO life cycle. The IPO process is not just about raising capital. A public company commits to shed light on its operations and strengthen its controls and governance in ways not required of private companies. The securities laws and the relevant listing standards, for example, require a company to form an audit committee. It must establish disclosure controls and procedures and create internal controls over financial reporting. The CEO and CFO must certify to the adequacy of those controls, and the company must be audited by a PCAOB-registered auditor or audit firm. This framework, serves quite important investor and market protection functions, including facilitating a board's attention to fulfilling its fiduciary duty to shareholders, particularly as a company grows in operations, revenue, and scale without adequate preparation and clear-eyed attention to the interests of investors, including employees. Directors unschooled in these areas may find themselves overlooking critical aspects of their duty, and companies will fail to have the controls necessary to assure accurate financial statements. While internal controls over financial reporting and the regulations and certifications applicable to them do not apply to private companies, all companies should consider enhanced structures and controls for conducting their operations, especially in anticipation of going public. Rapidly growing enterprises present significant risks if the appropriate control structure is not in place. Time and again, we see and have seen companies go public and grow at a pace that exceeds their control structure. For example, just last month, the Commission brought charges against a company and a former executive for inflating financial results to meet projections that it would double revenues in its first year as a public company. Because, in part, of insufficient internal controls, the executive was able to direct his subordinates to obtain false sales and shipping documents and intentionally ship the wrong products in order to book sales. So as the latest batch of startups mature, generate revenue, and achieve significant valuations, but stay private, it is important to assess whether they are likewise maturing their governance structures and internal control environments to match their size and market impact. Entrepreneurs and their advisors, venture capital and private equity investors, and those, and I would say that's a lot of you in this room, and those whose voices are heard and listened to in this market, all have an interest in this issue and should be asking of startups. Is your board expanding from founders and venture seats to include outsiders with larger and ideally public company experience? Do you have the right regulatory and financial expertise on your boards to appropriately make decisions on behalf of all investors? Do you have the relevant expertise in the particular industry in which your company functions to bring to bear different points of view and spot critical issues? Is your company, in short, being run and governed for the benefit of all your investors? A requirement whether the company is public or private, and it is the responsibility of all market participants and their advisors to ensure that this overarching obligation is fulfilled. Developments of significance, too, in the SEC's and Silicon Valley's space extend well beyond those I have discussed briefly tonight, and time does not permit me, obviously, to cover all of those issues, but I would be remiss, I think, if I ended my remarks without at least mentioning fintech developments, and I'll do this quickly, but innovations in digital finance, many of which obviously originated in Silicon Valley, really have the potential to transform how our markets operate in virtually every respect, from streamlined market operations to more affordable ways to raise capital and advise clients. These innovations compel us to think carefully about how best to protect investors so they and we can have confidence in this growing and changing landscape. In my closing minutes, I will just briefly touch on 3 digital finance developments that are impacting the securities industry: blockchain, automated investment advice, and marketplace lending. Obviously, topics in and of themselves. But blockchain technology has the potential to modernize, simplify, or even potentially replace current trading and clearing and settlement operations. As you well know, a blockchain or distributed ledger is a database comprised of unchangeable transaction data in packages called blocks. Each block in the chain is a record of transactions and contains information about the previous transactions. We at the SEC are closely monitoring the proliferation of this technology and already addressing it in certain contexts. For example, corporation finance staff at the SEC recently reviewed the registration statement of a company seeking to offer and sell digital securities, eliminating the need for intermediaries and allowing settlement on a nearly instantaneous basis. One key regulatory issue is whether blockchain applications require registration under existing commission regulatory regimes, such as those for transfer agents or clearing agencies. We are actively exploring these issues and their implications. Our advance notice of proposed rulemaking and concept release on transfer agent regulations issued just this past December, for example, asked for public comment on the use of blockchain technology by transfer agents and how such systems fit within the federal securities regulations as they exist now. The insight from that comment process will help us evaluate how best to regulate these new innovations and we encourage comment from all constituents. Another expanding technological development that has our close attention is automated investment platforms. These so-called robo-advisors offer discretionary asset management services based on algorithms and provide minimal, actually, if any, interaction between advisory personnel and investors. Many offer, or appear to offer, relatively low-cost investment advice, often with low account minimums, which has the positive potential to give retail investors broader and more affordable access to our markets. Like all registered advisors, robo-advisors managing over $100 million in assets or otherwise registered with the Commission are subject to the Investment Advisors Act of 1940. So in this area, the key questions are focused on whether and how a firm meets its Advisors Act obligations as well as its fiduciary duties when it provides only or primarily automated advice. Providing financial advisory services electronically is different than the traditional advisor model, but in many respects, our assessment of robo-advisors is no different than for a human-based investment advisor. Just like a conversation with a real person about a client's financial goals, risk tolerances, and sophistication may be more or less robust, so too there is a variation in the content and flexibility of information gathered by robo-advisors before the advice is given. As part of our effort to monitor emerging automated investment models, staff from our national exam program are examining robo-advisors. Through these inspections, we deepen our knowledge of the range of services provided as well as the challenges associated with different automated models. It is also an on-the-ground opportunity to proactively convey the need for these entities to operate within the framework of the Advisors Act. A third and final area I'll mention that we are closely monitoring is the continued growth of investments made via online marketplace lending platforms. This activity, as you know, broadly refers to using investment capital and data-driven online platforms to lend directly or indirectly to small businesses and consumers. As a threshold matter, the SEC evaluates these platforms through the lens, as you would expect, of the federal securities laws. That is, are they offering securities? And if they are the offerings registered or made using an exemption? We're also concerned about the adequacy of the information received by investors in registered offerings. We expect that investors will receive disclosures about the loans underlying their investments, including information about the borrowers as well as the platform's proprietary risk and lending models that will enable the investors to make informed investment decisions, both at the time of the investment and on an ongoing basis. As investors are attracted by potentially higher yielding but riskier marketplace loans as an investment strategy, information about the borrower's ability to repay the loan underlying the investment is obviously critical. Innovation in finance is welcome, but it must be built upon the disclosure of material information, which is the bedrock, of course, of the federal securities laws. Marketplace lending has impacts beyond investors and the securities industry. There are also many consumer and banking considerations, and that is why we at the SEC are engaged with our fellow financial and consumer protection regulators, including the Department of Treasury, the Federal Reserve, the CFPB, OCC, FTC, and the FDIC to develop really a broader understanding across the regulators of the online marketplace lending industry and the regulatory initiatives that would enhance investor, consumer, and borrower protections. You know, as I said, there are many other topics of mutual interest that I would like to discuss that our time simply doesn't allow. But I hope that I've conveyed tonight just how closely the SEC is monitoring and responding to developments in the private markets, as well as the relevant fintech phenomena. We, of course, recognize that the regulatory scaffolding around venture company advisors and private issuers is considerably scanter than that which frames registered investment advisors and public companies. And it only increases the challenge for the SEC that companies are increasingly choosing private status for longer, no doubt, in part because they believe it is the best environment to foster the creativity, the rapid cycling of success and failures, and yes, disruption that is the oxygen of technological innovation. We have a keen interest, though, in ensuring that all of the applicable rules and regulations are followed, and that the pressures that shape these markets do not lead to fraud and harm to investors. And we will provide the appropriate regulatory oversight to protect investors so that they can have the confidence in continuing to support the marvelous technologies for which this valley is so famous. You and your clients share in that responsibility, and indeed are closer to the action in many ways, and thus in a position to use a strong investor protection lens of your own as you go about raising money. And I challenge you to meet your responsibilities to investors with the same vigor you search for the next new unicorn. At the SEC, we want the exciting innovations of the Valley and the expanded ways of funding them to succeed. And I think working together, we up the odds of both success for entrepreneurs and issuers and the strong protection of investors that is ultimately essential to the success of your ventures. Thank you for inviting me to speak tonight, and enjoy what I know will be a lively and totally irreverent discussion, a panel discussion. Thank you.
Mary Jo, you do understand that the vast majority of people are going to remember only one thing from your talk, and is the tail wagging the horn. All right, I just want to calibrate your expectations along this line. If we could have our panelists join us, all right, up front. We've got a terrific panel that's going to be starting up in a moment. Just a couple of quick observations. In 1990, when I joined the Stanford faculty after having stepped down from the United States Securities and Exchange Commission, the extent to which Silicon Valley was interested in issues of law and public policy was really very simple. It was, let's get the R&D tax credit renewed every year because it was on an annual renewal basis. All right, that was pretty much it. The world today, in terms of law, public policy in Silicon Valley, I'd like to suggest, is dramatically different. I would ballpark approximately 25 to 30% of the capital valuation that we're currently creating in Silicon Valley as depending upon law and public policy as a core competence, not as something that gets bolted on. If you stop it, if you think about the business models of companies like Uber and Airbnb, there's a level at which there is some technological innovation that goes on with building a very efficient and very mathematically sophisticated matching engine that will allow people to find drivers and places to sleep. But all of those companies would fail, absolutely, if they weren't able to navigate a path through the legal and regulatory environment and cause significant change in how people think about law and regulation in the markets in which they're disrupting. An emerging core competence in Silicon Valley is not merely the disruption of tech space, it's also the disruption of public policy space. And I think that's a very important observation that we do need to keep in mind as we look at the question of law and public policy here in Silicon Valley. Let me just take a moment or two, introduce an absolutely spectacular panel we have here, and some controversial topics that we're going to take up that follow up on some of the matters that Chairman White mentioned. Steve Bachner. Steve is not just a partner at Wilson Sonsini. Steve is Steve Bachner, all right, of Wilson Sonsini. Steve served as Chief Executive Officer of Wilson Sonsini from 2009 to 2012 and is really widely viewed as one of the leading startup and corporate lawyers here in Silicon Valley. Andrew Seresny, sitting immediately. You want to meet Andrew only at our events here at Directors College, all right? You do not want to meet Andrew in his natural habitat, where he is the head of the Enforcement Division of the United States Securities and Exchange Commission. By the time you meet Andrew in his official capacity, it's too late, all right? There's a limited amount that we can do to actually help you. So in this room, and tonight, he's going to be a very nice guy. I make no other promises and representations in any other environment or in any other situation. Jessica Lessin, one of the leading journalists here in Silicon Valley, formerly the lead reporter for the Wall Street Journal covering Silicon Valley, now the founder of her own startup, an online service called The Information. And it's actually, I found, one of the most creative and innovative and helpful sources of information. So the name is actually quite appropriate in terms of what's going on in Silicon Valley, especially in the area where Silicon Valley bumps up against legal and public policy concerns. Leonard Stein, Senior Vice President, General Counsel, and Secretary of Splunk. Leonard has taken a company from private to public, understands all of the issues that Chairman White spoke about, and will be able to give us the very valuable perspective of a company that's actually trying to live within the context and contours of the extraordinarily difficult and highly litigious legal regime that we're operating in the United States. And Paul Vronsky, proud to introduce Paul. He's the General Counsel of Kleiner Perkins, Caulfield, and Byers. He's also one of my former students here at Stanford, so it's nice that we have proof that at least one person is able to overcome a Stanford Law School venture capital education and still move on and have a serious career.
Credit to you for all the correct answers.
So let me start. I'll move over and take the last seat, but let me just tee off the conversation. And Andrew, one of the concerns that is easily implicated by the chairman's remarks is regarding Silicon Valley employees' awareness of the capital structure, of the financials, of the preference stack, of the fact that unless a company is sold for at least a certain amount of money, the employees actually get nothing, and the reality that in many situations, employees are getting paid cash, but they're also working at the company in anticipation of a potential, and everybody understands, risky payoff by being able to cash out on their equities 180 days after the IPO. What are the SEC's concerns in this space?
Sure. Well, it's great to be here. Let me just say first, I'll give a disclaimer that Mary Jo didn't need to give, because the only person at the SEC that doesn't need to give this disclaimer is Mary Jo. But the views I expressed my own do not necessarily reflect the views of the commissioner's staff. And it's great to be here out in San Francisco. I seem to find myself here quite often. I think this is my third visit in like 4 months, and I'm coming back again in May. So you can't say that we're not focused on the West Coast. Not that you necessarily want us to be focused on you, but we are. And I think, following up on Mary Jo's speech to sort of just set the tone for this issue. I mean, obviously, there's a lot of arguments about the sophistication of investors in the realm out here, particularly pre-IPO companies. And, obviously, not all investors in these companies are actually sophisticated, at least when it comes to financial matters, and employees are amongst those that are not. And so we are certainly focused. One of the challenges in this area is there's no systematic disclosure regime that governs pre-IPO companies, and so the information that's out there is certainly sometimes sparse, and the accuracy of that information is very important. We're going to talk about kind of the role of the SEC in a minute, but obviously employees and the information they get to us is an important issue. I should also point out, though, that our focus is not just on employees and other investors who are less sophisticated, but I do think it's important to point out that even sophisticated investors need some protections. And I'll point to two things to sort of illustrate that. First is a case we brought yesterday, and the timing had nothing to do with the fact that the Silicon Valley Initiative was today. But the Burrell case we brought yesterday is a good example of sophisticated investors needing protection. Part of what we have found in this area, and also in the private equity realm, is that sophisticated investors don't know what they don't know. And so information they may not have available to them, and what may be going on behind the scenes is something that we can find and that they can't know. And so that's the Burrell case is one example of that, and a number of the cases we have brought in the private equity realm over the last couple of years are also examples of that. Fees and expense cases that I think exposed issues within the industry that maybe even the sophisticated investors didn't know. And I think it has led to tremendous change in that industry and tremendous focus on these issues. And I think that's part of, I think, what demonstrates the efficacy of what we do is changes that are caused in the industry as a result of the cases that we bring. And so, I'd be interested in what others think on this issue, but I think it's certainly a focus of ours.
Yeah, so Jessica, you've actually done some reporting. Your company's done some reporting around the issue of what do employees know and understand with regard to the preference stack and the implications? What are you finding?
They know very little, and we can tell this both anecdotally when we've done stories where we've asked 20 people who've just gotten offer letters if they understand what their offer means, and if they've realized that if you double the number of shares, it doesn't necessarily mean that it would be more valuable because there's something else called the price of those shares. So I think there's a stunning lack of information, and so what we've done at The Information is our team has gone through charters. So the data exists a lot of times when it comes to what the preferences are and what common shareholders have. It's just hard to find and it's not accessible, but we've found public charters for over 100 private tech companies, and we've created a database online where we've spelled out the preferences for each round, and we've even rated them based on if they were friendly to common, unfriendly to common, or neutral, based on pretty basic, is this a ratchet liquidity preference, that kind of thing. So this is one of our stories that we published. You can check it out on theinformation.com. And it's something that we're continually updating. And what we found when we published this a month or 2 months ago maybe is it really did hit a nerve. Companies started calling us and disputing some of it, not any of the terms, but just arguing one way or the other. And then some employees said that they were grateful for it and that it helped them start to think through offers. So I do think that there's a way to get more information out there. It's something we're committed to, but there's still a stunning lack of knowledge on the part of employees.
Steve, Paul, you guys are involved in this situation pretty deeply on a regular basis. What does it look like from your perspective?
I'll jump in from sort of the venture capitalist perspective and with sort of the tenor of a West Coast venture capitalist firm that generally believes in sort of what we would call plain vanilla terms, which mean the preference stack isn't all that complicated, though that's not to say that we don't have companies in our portfolio that don't have very intricate preferences and the like. But I would say more so than not, especially in our early stage portfolio, that's the case. One thing I think that it's an interesting byproduct of Jessica, The Information, and a few other providers of this type of information, we have seen an uptick in sort of obfuscation in charters as well. And this actually is a concern because to a large, it's sort of an arms race between company side lawyers and the media, and I think frankly even the SEC. So something like the Form D that's required to be filed in connection with the Reg D financing. A lot of companies in the Valley, particularly stage companies, don't rely on Rule 506 and the exemption that's afforded under the Securities Act, and instead do what's known as a 4.2 and then file a form with the state of California, which I think actually is not great from the SEC's perspective because, in addition to wanting to ensure that these, rules and regulations are followed, but you guys probably want to know what's going on in the capital markets, and right now you don't have that data. And I think, frankly, again, we should come to sort of an armistice, if you will, around what information really should be made public and what sort of, again, what will make sense there. Because I think the onus really shouldn't be on a group like The Information. They could probably find some other great things in the Valley to sniff out. It really is on the companies. And so when we come in as Series A investors, early stage, we really are, and our partners who are directors really take it on themselves, and we have certain operating partners as well in trying to help a lot of these people. And how do you present options and what their values are and things like that, and being good stewards and being value added in that regard, because obviously there are a lot of people who are very new to this. So I think the fact that people have to go to a website like The Information to find out what the value of their equity securities is really a failure on the part of companies and their advisors to a large extent and their investors in not facilitating that type of information exchange. So from our perspective, it is important. I mean, you could layer on even early exercise into this and these types of facets of it. It's a very complicated thing. It requires a lot of information. And I think to that extent, we could frankly all do better.
Steve?
Well, there's the question of what should companies be doing. There's no question that, there's a lot of market forces that are brought to bear on companies. You mistreat your employees, you're not going to be around very long to hire more employees. There's 10b-5 that we're concerned about, adequate disclosure. There's making sure there's a good exemption, so we worry about that. But, the question is, do we need more regulation in the area of, I think that's one of the questions, do we need more rules? And the construct we've got today basically is an exemption that says that, in the compensatory context, in other words, when somebody's not raising capital, but they're trying to compensate their employees, and if you're trying to raise capital, you're thrust outside of the bounds of this exemption, Rule 701, there actually is no information required under that exemption until you hit a threshold of having sold $5 million worth of securities in a 12-month period. So we actually have a regulatory construct that exists today that basically says, look, in trying to balance capital formation and helping companies with investor protection, the way that, that regulatory balance is struck today under the 33 Act and the SEC's rules under that 33 Act is such that, hey, in the compensatory context, we're going to throttle back a little bit because it's compensatory. Now, that doesn't mean bad things don't happen and employees are misled, but I guess the question is that I'm getting to in a long-winded way. Do we need more regulation in this area? I actually don't think so. I actually think it works pretty well. Andrew will have a better sense of, is there, what kind of whistleblower complaints and fraud that exist. But I think there's just a tremendous amount of market forces that are brought to bear in this context that oftentimes will keep issuers honest. And I think it's unfortunate that there has to be a third party that sort of provides relevant information. But I don't think I would then, leap to the conclusion that, okay, therefore we need more SEC rulemaking in this area. Because from my perspective, I don't think there's a huge problem here. I mean, you can always do better and provide better enhanced disclosure.
So Lenny, you see this from the perspective of the company as general counsel, all right? How does that look from your perch?
Well, I think one important point is that that disclosure is a different issue than financial literacy, and then even meeting the current standard for an accredited investor is not the same thing as financial literacy. And in our own case, as we crossed that 701 threshold and we were providing greater information to our employees, it really struck us at how difficult it was for the vast percentage of your workforce to interpret what those numbers mean and what decisions they should make based upon it. So our response to that was to proactively bring in a third party to conduct extensive education of our employee base. So as they devoted their own human capital to the success of the business, as they considered potential private secondary transactions, and as we moved to being a public company, they could make better informed decisions about how they allocated their own human capital and what they did with the equity they possessed.
And how common do you think that is in the Valley, Lenny?
It seems fairly uncommon. As I talk,
I just wanted to get it out there.
Yeah. It seems, as I continue to speak to first-time general counsel or general counsel of mid-stage or later stage private companies, that perspective is underappreciated.
Jessica?
One thing we're hearing that's more common is companies with perhaps cleaner terms have more of an incentive to explain, to combat just the valuation discrepancy. So if there's a headline out there that one company's worth $3 billion and the other's worth less than $1 billion, we hear more that the lower, they're making their case more, and I do think that's happening in a number of companies, which makes sense. Others, I think, continue to educate people, but educate them in a way that is advantageous to the company. So one of our reporters, who's actually over there, Reed, wrote a story about how Palantir in their offer letters has an equation or sort of a formula about what the company thinks it could be worth, and so you pull this slider, and this is what your package is worth. So that's also a type of literacy, but maybe not quite the same as an unbiased third party. And I think those formulas are more common now, but perhaps also suspect.
Yeah, so in other words, one of the things that I'm hearing is that maybe one area for improvement in terms of communication flows in the Valley between companies and their employees is greater transparency about what the capital stack looks like and how much money you will actually get contingent on certain exit valuations and different definitions of exits. There's a certain sense where, you can look at all of the financials and the like. Nobody cares, all right, about what your current EBITDA is. It's what's your EBITDA going to be 5 years from now, and nobody knows that. And the way you reduce that to the number that an employee will really care about is, well, if everything goes well, what do I think the stock is going to be worth? And if the company gets sold or goes public at a certain valuation, how much of that do I get to keep, all right, if, for example, not everybody converts or if everybody converts.
Those are also just getting much more complicated. I mean, we're hearing about equity clawbacks at some companies. I mean, so I think it's only getting more complicated.
Yep. A related question, Andrew, and this is something that the chair just touched upon more than briefly, concerns regarding the adequacy of information that goes to individuals that are purchasing in secondary market transactions. What views do you guys have at the commission about that?
Yeah, I mean, it's an extension of this, right? I mean, it's a step removed from the employees who are at the company and VC firms that are investing in the companies and others. Secondary market trading obviously has additional risk to it because, again, sparseness of information, even more sparse off in secondary market trading. So we're definitely focused on that. I mean, there are issues in terms of secondary market trading that go beyond the information. It's the structure of where the trading is actually occurring and the venues in which it's occurring. Unregistered broker-dealer activity is something that we've seen in the past. And now the swap issue, which we can talk about now if you want, but certainly transfer of interests as opposed to the actual stock is more common now, I think, as companies have imposed certain limitations on the transfer of the stock itself. And that raises issues about the structure in which those are being transacted and whether those amount to essentially swaps that then are subject to regulations that relate to securities-based swaps. And that's an issue that we've seen a fair amount of issues with, and we're focused on that as well.
Right, so maybe you could be more concrete in terms of the types of structures you're seeing that are giving you a little bit of agita in the enforcement division.
Sure.
You've already sued people here in Silicon Valley about this. Don't
We
be
have.
shy. Don't
We
be
have.
shy.
We have. You're probably referring to the Sand Hill case, which was our first case relating to the regulations that govern securities-based swaps. I'll just give a little bit of a primer about what a swap is and then what a securities-based swap is. A swap is an agreement, contract, or transaction whose value is based upon or derivative of the occurrence of an event or value of something else. For example, securities. And then a securities-based swap is any agreement that is a swap and that is based on, among other things, a single security or the occurrence, non-occurrence, or extent of an occurrence of an event relating to a single issuer of a security. So that's a swap. So basically, if you're transferring an interest in the security so that, for example, if you're waiting for a liquidity event and liquidity event occurs and you essentially transfer the interest in whatever is made during that liquidity event, that could be a swap. When you have a swap, you need to then determine whether it involves eligible contract participants, ECPs as it's known. An eligible contract participant is actually more than an accredited investor, and so it's either a financial institution or an individual who has amounts invested on a discretionary basis of more than $10 million. And so it's a pretty hard standard to meet generally. And if the transaction doesn't involve ECPs, then you have to, number one, have to register those transactions, and number two, trade it on an exchange. And so the fact is, when you engage in these sorts of transactions, typically it's not going to meet those two criteria, the registration and the trading on the exchange. And so that creates an issue. And these rules are in place in part because of the risks and other issues that arise in swaps, and they're transferable to this context, even though probably initially these rules weren't contemplated, these types of transactions weren't contemplated, but they fit into the framework, I think, of the broader swap rules.
Right. Steve, from your perch, you probably see lots of these different transactions where people are trying to get liquidity in a secondary market, particularly as companies stay private for longer periods of time. They're perfectly legitimate reasons why somebody's been in a company 7 years. You can't buy a house in Palo Alto with restricted stock, all right? The brokers won't take it. You actually have to get liquid, and if you're pre-IPO, you want to go out and get that house, and you got to buy a Tesla. You can't go shopping without a Tesla, all right? You can't go to Costco without a Tesla in Palo Alto. So what issues are you seeing in this kind of an environment?
There's been a real evolution in this over the last, 7 to 10 years, going from, maybe in the sort of the Zynga LinkedIn era when these secondary transactions just started happening without the really knowledge or control of the issuer, to today, a dynamic where the issuer has a real vested interest, and most issuers are taking a real interest in controlling and understanding what's going on out there. And there's lots of good reasons for that. You don't want to have so many shareholders that you inadvertently become a 34 Act registered company. You want to make sure there's some parity of disclosure, because to the extent the issuer is involved, and most of them want to get involved because they want to know who their shareholders are. You worry about aiding and abetting liability if you're just a little bit involved. So the term secondary transaction really is a very broad brush and covers just a whole range of things from issuer self-tenders to employees, which we're seeing to provide the liquidity, Joe, that you mentioned, to buy the Tesla or the house, to third-party tenders involving accredited investors, to other more esoteric kinds of transactions that I think Andrew was alluding to in that Sand Hill situation, where retail investors are exposed. And I think in the latter case, obviously, that's going to, I think based on some of the comments Andrew's made in public speeches, that seems to be the primary focus. But I think most, the issuers that I see are actually doing measured, controlled liquidity programs with investors they're aware of, who are largely accredited, and they want to make sure that they know who their shareholders are. They want to control the shareholder base, as I mentioned, and they want to provide some parity of disclosure. And the disclosure is actually tricky in these situations, because it's not, oftentimes you're worried about the person buying the security, but sometimes it's a board member or a venture fund that's providing the liquidity. So you're actually worried, we lawyers are worried about disclosure the other way, which is, are the employees going to come back to me and say, hey, you should have told me that when I engaged in this transaction with venture fund A that provided the liquidity, I didn't understand X, Y, and Z, and so you really have to, it's an interesting disclosure conundrum, because you got to provide really balanced disclosure with risk factors both ways. But Joe, I guess the short answer is I'm really seeing issuers take much more proprietary interest in their secondary transactions today.
And Lenny, what perspective do you have with regard to what your company's doing when you were private, and you had these types of situations?
Well, we were private in the good old days, which was 2012. So we'll celebrate our 4th anniversary being a public company in 2 weeks' time. Well, back then we had similar concerns. In our case, we had our lead venture investors anxious to exercise their right of first refusal anytime there was a desire to enter into a third-party transaction, and there were the issues that we thought through around that. We were, as was mentioned by Steve, we were at the early days of the rise of these marketplaces, and so we had to give a lot of thought to the asymmetry in information in those transactions, where we had accredited very sophisticated investors looking to invest in the company, and we had employees in the company with a greater level of knowledge than the investors had at the time. And fortunately, we had a very limited number of those transactions, and we were very thoughtful about how we were involved or not involved in those transactions. I will tell you that as there are more and more vehicles to raise capital and there's more complexity, I worry understanding how many challenges that private companies have in just launching and moving their business forward, and their sophistication in use of counsel, when to bring outside counsel in. In many cases, they won't have a general counsel, or they'll have a relatively inexperienced general counsel. So I think the execution risk, both to the business itself and to being successful in managing these kinds of transactions, are much more fraught the earlier a company is in its life.
I did want to jump in real quick, because I do think especially as it relates to employee equity in this realm and sort of this safety valve, and I have to completely agree with Steve that even over the 4 years I've been at Kleiner, the level of sophistication and just sort of smoothness even of the type of secondaries we participate in with employees and the like is really great. But there's a lot of ping pong though in this regard, where the response to what was happening in the late 2000s was to shut down in the bylaws any secondary transfer activity, which probably was an overreaction. And now there's all this talk of extending the employee's ability to exercise after termination or leaving a company from 90 days, which probably was too short, to 10 years, which is probably way too long. So there are all these tensions, and then you throw in early exercise and tax liability for people, which can be astronomical. And there's so many different tensions and tugging and pulling that at some point you've got to, come back to square one and say,
Let's keep it simple.
well, let's keep it simple. And also maybe even go back even further and say, does 4 years, 1 year cliff option, does that make sense? Are RSUs the right thing? I mean, there's this whole field has mushroomed in such a way that really, to some extent, there's got to be sort of a step back. And yeah, we advocate all the time, keep it simple, stupid. That's what we understand, and that's the reason why we like to sort of keep it down that fairway. But everywhere else, I think it seems to just be just almost getting out of control in that regard.
So let me take a step back and let me throw sort of a provocative question to the entire group. And that goes to the SEC's role in policing Silicon Valley transactions. Andrew, what the hell are you doing here?
Why are we
Andrew,
here? Right?
Andrew, why don't you go back to Washington and catch the crooks in New York and do the job for which the American taxpayer is paying you? And here's the basis for the question. Let's assume for a moment that the vast majority of transactions here in Silicon Valley involve what you would call 4-2 fend-for-yourself investors, not merely accredited investors under, Reg D. All right, and for those of you who aren't securities law wonks, let me translate that into English for a moment. The securities laws, basically Regulation D says, if you're worth $1 million net of your house, you're an accredited investor. You may be a total idiot when it comes to anything having to do with finances, but God bless you. You've got $1 million, you're therefore an accredited investor, and you can go do all of these private placement investments, all right? There's another perspective that comes out of Supreme Court opinion called Ralston-Purina, all right, SEC versus Ralston-Purina, and there it says, we're not looking at the amount of money in your wallet. It's not what I call to my students a wallet test. It's actually a brains test. Are you able to fend for yourself, all right? Here in Silicon Valley, the vast majority of transactions really do involve Ralston-Purina, fend for yourself, we're partnerships, we're VC firms, we're sophisticated operations. We may be wrong, but we know what we're doing, all right? Now, if that's really the case, Andrew, why are you here?
If that's the case. Well, because that's not always the case.
No, I understand. To the extent that we've got retail that's involved here, I get it.
I
But
understand.
that's not what's driving this market.
No, I understand. And as Mary Jo said when she spoke before, I mean, the primary hook that we have for things out here is really the anti-fraud laws, right? I mean, obviously, making misrepresentations in the sale of securities is ultimately a violation of the securities laws. And, it's our mandate to essentially police the markets, because even if in a particular transaction, they have very sophisticated investors, the market as a whole will lose confidence if you're seeing that over and over and over again. And even if the sophisticated investors are the ones losing the money, we want to preserve the market as a whole. And so I think, in part, that's why the securities laws make it illegal to engage in fraud in the offer or sale of securities.
So let me ask a pointed question. Have you got, other than these sandhill jokers, all right, who are just a flea on the speck of idiocy, all right? Are there any, look, people lose money all the time in Silicon Valley, but we tend to lose the money in a pretty honest way. All right? All right? Look, the technology didn't work. We knew that we were taking the risk.
That's right. If the representations that were made to you were accurate, that's right. And you've lost the money fair and square, and that's the way the market works, and that's the way we want the market to work. But the issue is that people often will, not often, but people will sometimes lie about what, in fact, is going on at the company. And the insiders of the company are the ones who actually know the truth. And so in the representations that they make, if those representations are false, to us, it's important for us to be there to hold them to account. Because I think from, greater societal interest here is in making sure that people, when they offer securities, tell the truth. And we have, and, the fact is, we have a number of investigations that relate to misrepresentations made in the offer or sale of securities. And even if the investors are sophisticated, as I mentioned earlier, in the case of private equity, but also in the case of VC firms, there's lots of information that they just don't have access to and can't see. And in fact, the founders are sometimes, not giving them that information. And, even if they decide to invest notwithstanding that, they're entitled to assume that what they're being told is truthful. And if we get into a situation where people are out there, lying with reckless abandon, even if people are losing, I think the market loses confidence. So our role is to make sure that investors generally have confidence.
I know better than to ask you about cases that are under investigation. I know not to do that. But to my recollection, I don't think the SEC has ever brought an enforcement action saying that there were lies in connection with the sale of Silicon Valley stock.
Yeah.
I think that's right.
No, I mean, I think we do have a number of areas where you see issues. And just the one thing that we're not sort of touching on, I think, is a lot of these companies that are in pre-IPO often sometimes go public. Mm-hmm. And so some of the issues that have plagued these companies when they're pre-IPO then exist when they go public. And it's not like all of a sudden overnight these issues go away. They obviously sometimes get bigger. And so from our perspective, we're also concerned about companies, when they go public, are they making misrepresentations? And public shareholders are harmed by that. So, I think it's not only in the pre-IPO stage. We certainly have brought many cases against companies that have gone public. The Marrone Bio case is the most recent one, which recently went public, essentially promised doubling of revenues, and they had to engage in fraud in order to actually potentially meet that standard. And so you see revenue type issues, expense type issues. A lot of these sort of nascent firms have arrangements with customers to try to induce sales and try to create sales, have complicated arrangements in terms of inventory and returns and the like. I remember when I was in private practice, I handled a number of cases arising out of the 2000 bubble involving revenues. And those were, again, companies that went public and ultimately, because of some of the things they did when they were private, they carried over when they went public. And I guess the other thing to mention is controls. Mary Jo mentioned in her speech. Obviously, a lot of the controls that govern public companies, 404 and other of the controls certifications and other things don't apply to private companies. But controls, I think, have I think a couple of relevant aspects to private companies. One, if you don't have appropriate controls, sometimes your measures like revenue and expenses will be inaccurate. And so having those controls is important for the accuracy of your financial statements, even when you're private. But second, when you go public, those obligations will, in fact, govern what you do. And 404 will apply, and some of the other internal controls provisions will apply. And you can't just turn those on overnight. You can't just all of a sudden one day, have controls. And so it's important for you to develop those when you're in a pre-IPO stage and then use those when you're public.
Right. So Jessica, in your reportage, do you come across many situations where people say, my goodness, there were misrepresentations, there was fraud in the sale of securities here in Silicon Valley?
We don't, with one exception, which is just some of the huge rounds where banks have been offering Uber shares to wealthy individuals in Kansas kind of thing. So actually, this is not the misrepresentation point. So we haven't come across that. But to the point of the sort of sophistication and the vast majority of this being venture investors and people with a ton of experience, I think that's largely true, but of course, mutual funds are huge investors in these companies now, and they have a very wide range of shareholders whose interests need to be looked out for. And again, it's tiny numbers, but it's still obviously an area when you have Fidelity as one of the most active investors, and as we've seen, been marking down and adjusting their stakes valuations. And then in a couple cases, specifically, basically Uber, where they've just been raising gobs and gobs of money, and so wealthy individuals everywhere can, through Morgan Stanley or Goldman, get access. We've been called by 2 individuals who were approached by those banks and wanted more information about Uber, who literally reached out to information reporters. So maybe they were just being very, very thorough, but they felt like they needed more information. So it's an interesting question because these are obviously beyond exceptions to the rule, and I'm not sure how much law enforcement and regulators should care about, individuals when we're talking about such a pool. But I think the exceptions do exist.
Yeah. Steve?
Yeah, I was just going to say, I think the Division of Corporation Finance is doing a review of the accredited investor definition. So it'll be interesting to see where that ends up, because I think one of the tensions in this area is some concern that maybe that definition now, which is, many, many, many years old, is too low a threshold. But, whatever that threshold is, I think those are the investors that are presumed to not need registration level protection. Obviously, if you're going to commit fraud and lie to people, Andrew and his team are going to pay you a visit probably. But I think for the classic, Silicon Valley financing, where you've got an issuer that's selling to Paul's company, we don't really see a lot of fraud there, and the Kleiner Perkins of the world can protect themselves. They protect themselves through due diligence. They have, legal recourse. They do extensive reviews before they put their money in. So I think the areas to watch are the ones that Chair White mentioned. We have all these new innovations, crowdfunding and Reg A+, and I'm frankly a little dubious as to whether those actually get traction in the classic kind of financing. I'm not saying it. Maybe other people on the panel are. I think the classic venture financing is going to be done the way it's always been done, which is a small group of individuals funding a company, maybe some angels. 506C now we can generally solicit, but if we get that accredited investor definition right, which is those are really investors that don't need registration level protection, and the company takes reasonable steps to verify. There are no information requirements, but the fraud standard continues to apply. So, I would be surprised if in the future you see a lot of problems in the classic Silicon Valley financing arena. I think there's just such a proliferation of new ways to raise capital and new ways for secondary liquidity that it's not a surprise that, the commission and the staff are watching those carefully.
So, Paul, how quickly do you think we should get Andrew on a plane back to Washington?
Well, so I was going to sort of approach this question a little bit differently because, I mean, I think when you use the word policing, you can sort of think about the baton-wielding police officer. You can think about the police officer sort of nicely walking the streets and chatting up their neighbors. And I mean this analogy to go towards the things that the SEC and Congress have done in the capital formation area, things like the Jobs Act and the recent improvements to the Jobs Act where, and to Steve's point, there's a lot of really plain vanilla, good guy and gal financing that happens in Silicon Valley on a regular basis. And to the extent the SEC can help that along and help private companies that are doing things right by their investors, their employees, and the like, and help them enter maturely into the public markets. I think that's something, again, from the SEC's perspective, sort of looking in the mirror and saying, okay, where can we, lighten up, and where can we look at something like a Form D and make it practical in the event that we are talking about fully accredited investors and things like that. Where can we make, the 8K filings, which can be Byzantine, and the day requirements and all this stuff, Section 16. There's so many different facets of being a public company that makes sense, that they're good rules and regulations, but can we do what we did with the Jobs Act? Can we look at companies that are young public companies and give them sort of a lighter touch or maybe an easier path towards that liquidity? Because frankly, I think a lot of the problems we're talking about on this stage, whether it's secondary liquidity, employees not having issues, I mean, it's primarily, in my mind anyway, driven by the fact that companies are remaining private for not too long. They're remaining private for as long as they feel the need to. And if we can loosen that up on not loosen up might be the wrong word, but make it more attractive to be public, I think it could alleviate a lot of those concerns and frankly drive the type of results that you're talking about, especially on the internal controls and those types of things. So I think, again, I look at, again, policing is a two-way street and really could use that from the SEC's vantage point to help us.
So, just as an aside, and Lenny, I'd like to get your view because you've lived this as a private company, a public company, but the population of publicly traded companies in the United States is down by approximately 50% from its peak in 1998. Now, it's a very interesting economic question as to why the population of publicly traded companies is down, and I think it's a big mistake, a huge mistake, to blame all of it on SEC regulation. All right? There are many more interesting things that are going on in the marketplace today that are causing companies not to want to go public, to prefer a merger as an exit rather than an IPO, changes in liquidity structure where mutual funds aren't as interested in funding IPOs that coming in at lower market caps. So minimum efficient scale to IPO is higher now than it used to be in the past. So it's a combination of microeconomic, macroeconomic, and regulatory forces. But I think apropos of what Paul's saying, it's hard to say that the regulatory burden hasn't been a factor in reducing the number of publicly traded companies by 50%. Lenny, you've lived life on both sides of the fence. Private company, public company, what does it look like from your perspective?
Well, in terms of the perspective of contemplating going public and being part of a public company, this is the fourth public company I've been the general counsel of, and it is a significant burden on the company. A lot of the things you do in going public and being public are incredibly helpful and good for the company and its shareholders, but it is an ongoing burden that is not trivial. In terms of the earlier question, it's something that I face as a public company general counsel is thinking about things about control of material non-public information, trading, windows, policies, training, and things like that. And I think a lot of the concerns you have as a public company general counsel are now, coming back more and more into the private company realm, particularly in the Valley where we have a culture of either extreme transparency within a private company or extreme access to data enabled by cloud infrastructure that most private companies rely upon. So one of the things that I find interesting, both as a private company and as a transition to a public company, is the importance to focus on information governance. If you have tools like Salesforce or Workday or Anaplan or other types of tools where you have broad access within an organization, you have to be really thoughtful because there's a lot of material, non-public information in that. And as you make that migration from either a private company to a public company or a private company that is having more and more secondary transactions, that kind of information governance needs to be much more sophisticated and nuanced. And that I think is an emerging issue and something that
So I think to
thought.
translate a piece of that into English for people in the audience, in old technology, in the old days, a couple of people in the CFO's office would know how well we're doing in terms of tracking to the quarter, right?
Right.
Now, with the new types of software tools, and particularly with a open environment philosophy, the number of people within the company who can reasonably predict whether we're on track to making the quarter or not is much higher than it used to be. That gives agita to guys like Lenny who've got to worry about information leaking out of the company and people engaging in what otherwise would be called insider trading by Andrew, and not unreasonably called insider trading by Andrew. So this is a very interesting evolution we have here, that as information technology within the corporation changes, and it changes in large part so that you can manage the company better. Everybody can see how we're doing in terms of tracking the quarter. Well, wait a minute, that's material non-public information, and the number of people who now have it has now exploded. It used to be people would have the information on a need-to-know basis. Now the philosophy of need-to-know is, well, everybody involved in the company needs to know for one purpose. Is that a piece of the problem you're running into?
Well, it's something that you have to be mindful of, and it's not just financial data. It's, how is the next launch of the product tracking? What are the inventions you're filing patent applications are? What, all types of information now that are part of the foundation of the 21st century company are more likely to be found in the cloud. Right. And more
more broadly shared within the company.
Well, and what it just requires, maybe yes, maybe no. If you're thoughtful and mindful, as we went through our process, we looked at every one of those tools. We thought very carefully about who had access to what information, what type of controls were in place, in terms of making sure that people with knowledge were properly schooled. We have a very, very broad pre-clearance. We have a trading window that applies to 100% of the employees in the company. We have a very broad pre-clearance program for every trade. We have extensive training and certifications because of just this concern about ubiquity of information.
Well, it strikes me, though, this is not
a thoughtful look.
This is not unique, obviously, to Silicon Valley, right? I mean, I think many companies across the country have this issue now that information is much more broadly available. I mean, another example is, we had a case we brought, I guess, a couple of folks who were Capital One employees who obtained sales data from credit card information of their clients so that they could see the amount of sales and then traded on that information in the companies in which there were those sales based upon that. So, you have this issue in a whole bunch of companies, and I think the control of data and what that means for insider trading policies and like is a big issue across the country, I think.
Yeah, so the chairman and several panelists have already, raised the question about the involvement of mutual fund companies here in Silicon Valley. And this is a relatively new event, all right? It's really primarily within the last 12 to 18 months that you've seen a reasonable number of mutual fund firms coming in late-stage financings, typically of unicorn-type companies. Let me ask a question for you, Steve. How many companies that took money from mutual funds, understood that the funds would then periodically and publicly be valuing their shares, and that the company would have no influence over the mutual fund's ability to put an opinion out there that, you know, we bought it at a $3 billion valuation, we now think it's worth 50 cents.
Well, I don't know the answer to that question, but I think a lot of people were surprised.
Right. And do you think that the knowledge that some companies have gained has led to a situation where if you can do a financing round, all other things equal, and you can let Fidelity in, or you can do it without a mutual fund investor, that you'd rather not have a mutual fund investor now?
You know, I think it's a more nuanced question. I mean, one of the reasons why the Fidelity and T. Rowe Prices of the world are attractive to a late stage private company, in part, are to get acquainted with the group of buyers that are eventually going to be there for the IPO. So I think if it's a company that's kind of scaling towards an IPO and is going to have a public trading market anyway, and so on, I think those issuers are more likely to still be attracted by having, you know, institutional investors have a seat at the table, engage with those, maybe have some anchor tenants as they build the book in the IPO. So I think that will still be attractive. I think perhaps earlier stage companies confronted with that reality might be a little more gun shy, perhaps. Paul, what do you think?
I find it a slight tangent, but an amusing parallel to this to what happened in 2000, roughly 2002, 2004 timeframe when venture capital firms learned that the public pension funds and university endowments, public university endowments, subject to FOIA laws, would have to disclose the valuations, and all of a sudden that changed capital formation in the venture and private equity industry somewhat, and away from those folks.
So basically what it means is that many, again, I'm going to translate this into English, high-class venture capital funds that can close $1.5 billion round without taking money from anybody subject to a FOIA obligation,
Freedom of Information Act.
Freedom of Information Act obligation, will shut those investors out. So if you want to get into a high-quality VC fund, and you are a state pension and you're subject to FOIA, and they can close the $1.5 million without your money, bye-bye, you're not getting in because of the Freedom of Information Act requirement.
Yeah, and so that was just an aside. I do think there's an additional element, and Andrew and the SEC, I know, have been talking about this with respect to private equity and venture capital fund valuations, especially as they go out and raise money, and I think the challenge for us as these numbers get published, and it's crazy to see how much they fluctuate from month to month and from fund to fund, and it really highlights, again, and something that we live with. We just sent out our audited financials for the last year for all the funds under management for us. Doing private company valuations is extremely challenging. And it's more so when you have very limited information available to you. And so again, I mean, we hear this throughout this entire evening. You know, access to information is so important. It's important, obviously, when you're making investment decisions. It's also important when you're valuing things, and when firms like us then go out to raise the next fund, and we have to, in some sense, rely on our track record. And it's hard to do when those investments take years, if not decades, to mature and actually have real market valuations. So it's a challenge, and it's only been made sort of increasingly more so because you have this additional sort of unfiltered data stream coming, and it's been hard to have that enter into the sort of lexicon of folks. I mean, and credit to outfits, and not to ingratiate myself too much, but outfits like The Information, which are trying to put this all together in context, because it's very easy. I'm always amazed when like a new S1 goes public. I vividly recall this about Squares, and nobody understood the ratchet. And so many tweets and stories front page stories were written completely obliterating how these things work. And so whether it's these mutual fund valuations and putting these things into context, I think it somewhat is incumbent on the media in this case to really help folks understand it, because we're having a hard enough time dealing with it on our end.
Well, yeah, Jessica, you've done a lot of coverage of this issue, and now the Wall Street Journal actually has an online tool that tracks, all right, every mutual fund valuation of every private company in Silicon Valley. What are you seeing from your perch?
So we've been trying it for over a year. So started writing about the markdowns, I think when BlackRock marked down Dropbox about a year ago. But it did take us a while to find some of the explanations for the methodologies. So when it first happened, the companies were saying this is not a story, it's all just tracking to public comps. And we're down because Box is down. That's the reason, right? That was the Dropbox line. And they said this over and over again. And we were finally able to chip away through reporting and the disclosures. Again, there's a lot in the filings. And so what one of our reporters was able to do, several documents had sample or explanations for the markdowns, and they didn't say what company it was for, but they said it was for a company in which they owned XYZ number of shares. And later in the same filing, they said, we own XYZ number of shares for this company. So that's literally how we did it. So that's what you get with the information. So anyway, we were able to see for companies like Palantir, for companies like Didi Quidi, for companies like Uber, what was driving some of the changes, and wrote about it. And it's really a mixture, though. Some of it, their actual multiple they were applying to the business changed. Sometimes it was public comps. I mean, you guys know as well, there is a separate committee, obviously, that is doing this from the fund managers, but in some cases, they rely heavily on the fund managers. So what we're finding is there are a range of explanations, but you can kind of start to peel back the curtain a little. And we do hear from founders who say, not I won't take Fidelity's money or T. Rowe's money, but I'm not going to take it in a B round. I'm going to wait until I'm really about to go out the door, and then I'll take it.
So we've got a million more questions, but I think the prudent thing to do is to give the audience an opportunity to ask some questions from this distinguished panel. So if anybody would like to move, we've got 2 microphones that are set up over here. This is your chance to ask Andrew Serezny questions in a safe and protected environment.
Hi. This is a question regarding private equity. One of the private equity has a lot of investments in pre-IPOs companies, so I feel like the question is relevant. Both Blackstone and KKR had recent enforcement actions, and Blackstone was fined for not disclosing accelerated monitoring fees, but KKR was not, even though it was engaging in effectively the same behavior. KKR was fined for broken deal expenses, but Blackstone was not, even though they were engaging in the same behavior. So my question is to Mr. Serezny here, is the SEC engaging in symbolic enforcement actions to send the message, or if you are guilty of of the same violations, should you expect enforcement action? And so, what kind of resource constraint issues does that present for the SEC?
Sure. I'm not going to ask your name. Or your affiliation. No, I mean, I guess I'm just going to talk about publicly available information. I don't know what information you have. I know what information I have. We did bring, obviously, actions against Blackstone relating to accelerated monitoring fees and also legal discounts. You didn't mention that. As well as a case against KKR relating to broken deal expenses and the failure to disclose how they were allocating, et cetera. And each of those cases has different facts, different issues, but they do boil down to essentially a failure to disclose information to their investors about how they were allocating fees and what they were doing vis-a-vis fees. And we're seeing that time and again, and we've seen it time and again. I think you'll see more cases in this realm. To me, you asked, are we bringing these cases just as symbolic? No. I mean, I think these have real victims in the sense that the investors of the private equity firms ultimately were deprived of money that they should have gotten, and ultimately, as part of these settlements, they're getting the money that they should get, and that is the primary purpose of these enforcement actions. Do these enforcement actions have an impact on the industry as a whole? Yes, and we want them to have that impact. And in fact, as I said at the beginning tonight, in the private equity industry, you've seen tremendous change, I think, in response, really, I think, in large part, too, with these actions post-Dodd-Frank. Now they're being examined by our examiners. We're in there to see. And the information that investors thought that they had, they didn't actually have. And now they're actually demanding changes to partnership agreements and other things in light of the information they've now learned, and asking questions that they didn't ask before. And I think that's a great thing. I think it demonstrates. People always ask me, how do you measure the effectiveness of your enforcement program? Is it just the numbers of enforcement actions and the like? And I always have to say it's not just the numbers. It is the quality of the actions we bring and the impact it has on the industry. And this, I think, is a good example of the impact it has on an industry.
Next question. Yes, sir.
Hi, my name is Ben Stetson, and I live in Sunnyvale. First, I want to thank Chair White for coming out. It's a rare, very rare opportunity when a member of the public can address the chair or representative of the SEC. And in her opening comments, she said that protecting investor is the core of the SEC's mission. And as a retiree, my well-being and that of my family is, other than Social Security, totally dependent on our investments. And I'm here tonight to voice my disappointment in how the SEC is doing its job. I have and this is, anyone here can download this. It's called Rigged Justice 2016, How Weak Enforcement Lets Corporate Offenders Off Easy. It was prepared by the Office of Senator Elizabeth Warren. If you Google Elizabeth Warren Rigged Justice, you can download this. 13 pages, 3 of which are footnotes. Very easy read. Just have a couple of specific examples, and then...
I've read the report.
Okay, great. Because in here, J.P. Morgan's conflict of interest, and it comes down to...
I don't think it mentions, by the way, with regard to that case, that we did get admissions in that case, because a lot of the criticisms in that relate to the admissions policy. I don't think it mentions that we got admissions in that case that you're about to reference against J.P. Morgan.
The SEC almost immediately granted a waiver to allow J.P. Morgan to continue access to special regulatory privileges that are designed for law-abiding banks. This is after they paid a $300 million fine to SEC and to the CFTC.
Do you want me to talk about waivers for a minute?
I'm sorry?
Do you want me to address the issue of waivers, which is what you just referenced?
Sure.
Okay, so just so you understand, disqualifications from certain types of activities apply if certain types of actions are brought against particular companies or financial institutions in this case. And those disqualifications can be waived in certain circumstances. And what other divisions, enforcement divisions not involved in the determination of a waiver, in that case, Division of Corporation Finance is often involved in the determination. Some other divisions are sometimes involved. And they make the determination based upon the action as to whether that particular financial institution should be disqualified from engaging in the business activity that's involved. So in this case, for example, in that case, it would have been a business activity that related to the bad actor engaging in 506 offerings, basically, and private placement offerings under 506. And in light of the activity here, the Division Corporation looked at that and determined that the conduct in that case did not mean that they should not participate in that part of the market. And so did a fact and circumstances analysis and determined that. And so the waiver issue has been one that's been out there in the public, but it's not an issue relating really to enforcement. It's a separate issue that's handled by different divisions, and they apply criteria that are published and on our website to determine whether disqualification should apply.
Right.
If you're-
Next question. Sorry, next question.
Thank you. And this goes partly to Andrew, but partly to the others. I'd like to hear from you. You did reference the deterrent effect, and there's no question when an enforcement action is brought, the industry changes. By the same token, when examiners make findings, and those are reported by leadership like Mark Wyatt, and there's a lot of great examiners in the room, the industry makes changes. When you speak at a panel or when Mary Jo speaks, the industry makes changes. Doesn't seem like enforcement is always necessary. And couldn't there be greater use of just relying on the exam findings or on public pronouncements, which don't have the same devastating effects to people who are at the receiving end of an enforcement action? And I'd like to hear from other panelists as well if you think you would change your conduct just sitting on a panel like this or reading about these things in the paper.
Well, I'll briefly answer. I mean, I think that's right. I mean, I don't think the only thing that causes changes in conduct is enforcement actions, but I do think when you have a violation, it's appropriate to have an enforcement action for that violation. There are obviously deficiency letters still issued in connection with exams where there are issues found, and those are typically remedied. But the one thing I'll just say with regard to deficiency letters and OC and our relationship with OC, over the years, in the last 5 years, about 10% of exams have resulted in referrals to enforcement. It's been pretty constant. And so this idea that we're not using deficiency letters or otherwise using our other powers to remedy conduct, I don't think that's borne out by the evidence. But from my perspective, obviously, enforcement actions serve two primary purposes: one, to punish misconduct, and two, to deter misconduct. And so we bring the actions when we think it's appropriate. When somebody has violated the law, and we think a sanction is appropriate. I don't know.
So, ladies and gentlemen, we've kept the audience beyond the appointed hour. You've been extraordinarily gracious and patient with us. I'd like to thank you all for joining us, and if we could have a big round of applause for a spectacular panel.